In this video, I'm going to be explaining to you the circular flow diagram and the economic cycle diagram simply. Starting off with the circular flow diagram, in a closed economy, households will receive factor incomes, which is wages, rents, interest, and profits. And firms will be paying these in exchange for the factors of production that the households will provide. Upon receiving their incomes, households will spend their incomes on goods and services which are produced by firms. As you can see, this completes the primary loop in the circular flow diagram, as expenditure equals income. The great investor Ray Dalio explains this very simply by saying, your spending is my income, and my spending is your income. And just in a few words, this is essentially the circular flow of income model. Now moving on to leakages and injections. The first is the financial sector. When households receive their factors of income, and instead of spending it to the firms, they save it. This will be a leakage in our circular flow. The income will leak directly out of the circular flow and go to banks and brokerage accounts, and the money will be stored in the form of cash, stocks, or bonds. But due to this, an injection will happen from the financial sector, as firms will obtain the necessary funds from financial markets by borrowing money. As firms will be borrowing money from banks, which are essentially deposits made by households, the funds will flow back into the expenditure flow as an injection. Now moving on to the government. When households receive their income, the government will place a tax on this, as taxes cause a leakage as money is paid to the government. The tax rate differs in different countries, but the tax itself removes spending directly from consumer spending to the firms. But as government is spending money on public goods, these funds return to the circular flow as an injection. These public goods can be parks, recreational facilities, hospitals, schools, and so on and so forth. As a result, the money is recycled back into the economy. Lastly, foreign exchange. Buying goods from another country will cause a leakage, as they will need to supply their domestic currency to purchase imports from elsewhere. Instead of money going to the domestic firms in our circular flow, they go abroad. On the other hand, foreign countries will spend money on domestically produced goods. As a result, this injects money into the circular flow economy. So in a circular flow economy, there are leakages and injections by these three components, which is financial sector, government, and foreign economy. Now moving on to the economic cycle. Economic cycles are short-term fluctuations in the GDP of a country. This is represented by this squiggly line. As you can see, there are alternating periods of growth and decline, and the actual GDP fluctuates around the long-term growth trend, and that is represented by this dotted line. So moving on to a boom, this is when there is positive growth in real GDP. In this period of rapid economic expansion, the GDP is often higher than the long-term trend. As a result, employment increases within the country as firms will produce more goods and services, and the standard of living increases. For example, China in the mid-2000s, they experienced double-digit GDP growth. And this boom saw a massive increase in investments, exports, and urban development. Moving on to a recession. A recession is a fall in real GDP, and this is defined as a contraction that lasts for 6 months, or 2 consecutive quarters. The impact of this is there's very high levels of unemployment, and price levels often slow down significantly. For example, the global economy in 2020, due to the COVID-19 lockdowns, this caused businesses closing down, Consumer spending declined rapidly and the GDP plummeted globally. This was a technical recession because growth turned sharply negative. Now moving on to the trough. A trough represents the cycle of minimum GDP. And this is the point where decline stops, and this marks the turning point of the contraction. And during this period, there is widespread unemployment. An example of this was the Great Depression in 1933. This was its lowest point for the US economy before the New Deal policies began to pull the country back into recovery. Unemployment was at its highest at nearly 25%, and prices were falling. Moving on to recovery. A recovery marks the beginning of a new business cycle as growth starts to return and employment starts increasing again. An example would be in the US from 2010 to 2012. This was after the financial crisis of 2008. GDP started to grow slowly, consumer confidence began to rise, and firms started hiring people again. And lastly, the peak. This is the top of the cycle where growth hits a maximum rate and the economy starts overheating. This marks the end of the expansion phase and unemployment of resources has fallen significantly. And in this period, inflation rises rapidly. An example would be the dot-com bubble in 1999. As confidence was at an all-time high, unemployment was extremely low, and the economy was producing at or above its full capacity. And at this point, inflation tends to increase quite rapidly. I hope that helped. I hope you guys have a good day. Bye-bye.